fairly simple process. Now, thankfully, life insurance has gotten a little bit more sophisticated. We don't see a lot of advances in the insurance field, in the life insurance field anyways, until the mid-1700s. And in about 1762 or 1763, we see the very first whole life insurance product sold. And what happens by this time, we do have a better understanding of mortality. If you could draw out mortality, you might see a graph that would look something like this. That in the early years of your life, you would find these reasonably consistent, steady increases in cost of insurance. But as you get older, mortality increases at a fairly quick pace. So for somebody in their 20s, for example, the cost of mortality increases really in very small increments year over year. Once somebody's in their 50s, then there are noticeable increases in the cost of insurance year over year. That is a noticeable increase in the likelihood that that person would die. Once somebody's in their 70s and 80s, then you see mortality start to increase at a very quick pace. So if you were to graph it out over time, you would see something like this as far as mortality goes. And you might imagine that the period at the bottom here would represent somebody in their 20s, and then we might have somebody in their 50s, and then somebody in their 80s, for example. So your mortality would be reflected on a mortality table. Now, by the mid-1700s in the United Kingdom, in both England and Scotland, we had these mortality tables developed, and this allowed these assurance societies to develop more sophisticated products. The product that they specifically introduced in 1762 is whole life insurance. This whole life insurance product was a fairly interesting idea. What happened was we averaged out what it would cost to insure you across your lifetime. So if you bought this at a fairly young age, you would have a little bit of a higher cost than what maybe you could have had. However, what you would know is that your cost of insurance would never increase for as long as you owned this product. And unlike the old term insurance products that I showed you a few minutes ago, there was no expiry date built into this product. That is, you start paying your premiums, and as long as you continue to pay those premiums, the policy stays in force. So it's really designed to give a more robust form of coverage than what the term insurance that we previously looked at would have done. We'll look at whole life insurance and term insurance for that matter in more detail in a later video. For now, we just want to understand these basic concepts. So with this whole life insurance policy, what we start to see over time is that insurance companies take this money, this overpayment of premiums, because really at this point you're paying more premium than what you need to, and the insurance company will invest that money. They build up a policy reserve. And that policy reserve now is the money the insurance company has set aside, because they know that when you die over here, let's say in your 70s, for example, if you die later on in life, you're not paying enough premium at this point now to make that up. That is, they're going to have to come up with the funds to cover that shortfall. They're going to get that from your policy reserve. So this policy reserve is really a pool of investments managed by an insurance company. They own this policy reserve, and they're going to use it to pay those death benefits as required. Now, in today's world, if you happen to own a whole life policy and you decide at some point, let's say you've been paying premiums for 25 or 30 years, and you decide here that you'd like to leave the policy, the insurer will actually make a chunk of that policy reserve available to you in many cases. The amount that they'll give to you is what we call the cash surrender value. The cash surrender value is that policy reserve less any surrender charges associated with the policy. With most whole life products, the surrender charges are pretty steep in the first roughly 8 to 10 years, but once you're beyond that period, the insurance company now has gotten the money that they expect to get, and they don't mind paying back some, or in some cases all, of that policy reserve. Now, there are a variety of ways today that we can structure a whole life insurance policy. What I've shown you on the board here is what we call a pay-for-life structure. However, we can shorten up our premium payment period. You'll find today a very common type of whole life policy is a pay-to-65 policy. In a pay-to-65 policy, what we're going to do is we're going to shorten the number of years that you would pay premiums for until, for example, age 65, and then it's going to increase the amount of premium you need to pay. However, you know that starting at age 65, you will no longer have to pay premiums. Your coverage will carry on beyond that point, but your policy will not require any more premium payments. You could also do a very similar type of policy, a 10-pay or a 20-pay policy. On a 10-pay policy, you would have a very short payment period for your premiums. However, your premiums would be quite a bit higher. And then at the end of that 10 years, we would take that policy, we have the policy in force, you're going to continue to generate policy reserve because you put that money with the insurance company, so this amount will continue to grow. You no longer need to pay premiums. Yes, it's a larger initial amount of cash that you're going to have to spend, but over time it can actually mean less dollars flowing out of your pocket. We'll talk more about whole life policies in a later video.